Let's talk about cryptocurrency, a revolutionary technology that has captured the imagination of investors worldwide. It's the digital gold rush that's made millionaires seemingly overnight, and propelled meme coins to unexpected fame and fortune. We've seen incredible stories of wealth creation, fueled by the promise of decentralized finance. But for every wild success story, there's a crash looming on the horizon, a sudden, brutal collapse where fortunes, built on speculation and hype, can vanish in mere hours, leaving investors reeling. So what exactly is a crypto crash, and what makes it so devastating? Imagine a Jenga tower, precariously built on a foundation of hype and speculation, fueled by viral tweets and sustained by pure, unwavering belief in its potential. When one key block, representing a piece of bad news or a shift in sentiment, is pulled, the whole thing can come crashing down. Unlike the more gradual dips in the stock market, crypto crashes are dramatic, often shockingly fast, and can be incredibly unforgiving to those caught in the storm. Prices can plummet 20, 50, or even a staggering 80% in a matter of days, sometimes even hours, leaving widespread chaos and devastation in their wake. The value of most cryptocurrencies isn't tied to any underlying asset or tangible resource. It's almost entirely based on collective belief and market sentiment. When that belief cracks, when fear takes over, the perceived value can evaporate almost instantly. There's often no central authority, no CEO to reassure you with calming words, and certainly no government bailout to cushion the fall, just the cold, hard math of supply and demand dictating the price. A crypto crash is essentially a global crisis of faith, unfolding in real time at the breakneck speed of the internet. When the music stops and the initial shock wears off, panic inevitably sets in, and everyone, desperate to salvage what's left, rushes for the exit simultaneously, making the downward spiral even steeper and more devastating. It's messy, it's often terrifying, and it's seemingly baked right into the very DNA of this volatile digital frontier. Ever wondered why crypto prices seem to crash harder and faster than almost any other asset class? There are three key reasons that contribute to these dramatic downturns. First, non-stop trading. Second, wild speculation, fueled by social media hype and influencers. And third, zero safety nets to cushion the fall. Crypto never sleeps, operating 24/7 across the globe. This means bad news from anywhere in the world at any time can trigger a global sell-off in mere minutes. The market is always open to react. Unlike traditional stock markets, there are no circuit breakers to halt trading during a free fall. So, when panic sets in, it can run wild and completely unchecked, leading to dramatic price drops. Leverage is everywhere in the crypto world. Many traders borrow significant amounts of capital to chase even bigger gains, amplifying both potential profits and potential losses. However, even a relatively small price drop can trigger forced sales, also known as margin calls. This creates a cascade of liquidations, further accelerating the downward spiral. Furthermore, most cryptocurrencies have no real intrinsic value or underlying assets. Their price is almost entirely driven by market sentiment and speculation. So, when the hype inevitably turns to fear, the consequences can be severe. Demand quickly dries up, leaving few buyers in the market. And then everyone rushes to sell their holdings at the same time, exacerbating the crash. Finally, automated trading bots amplify the existing chaos. These bots are programmed to dump coins at lightning speed based on preset algorithms. When thousands of these bots begin selling simultaneously, the effect is devastating. Prices nosedive even faster than human traders could ever manage. It's a perfect storm of raw emotion, advanced technology, and extreme risk all colliding at once. In the volatile world of crypto, it seems even the robots are prone to panic. In a crypto crash, fear takes over, fast. It starts with a rumor or a price dip, then spreads like wildfire on social media. Influencers who once shouted "HODL" now scream "sell," and panic goes viral. Fear, uncertainty, and doubt, FUD, becomes contagious, feeding a feedback loop of selling and falling prices. Logic disappears, survival instincts kick in. People sell not from analysis, but from terror of losing everything. The promise of quick riches attracts risk-takers, many of whom can't afford big losses. When the market turns, their fear is existential. This isn't just about money, it's about rent, savings, and dreams. The emotional toll turns a downturn into a stampede. In crypto, panic is always just a tweet away. Meet Billy, just your average guy, an everyday guy who, like many others, jumped headfirst into the world of crypto. He was eager to explore this new frontier of finance. What sparked his interest? Seeing a friend's flashy new car, a symbol of crypto success. Fueled by FOMO, he buys Rocketcoin with a loan, a decision he'd soon regret. He watches it double in value, then triple, and suddenly feels unstoppable, like a financial genius. But the euphoria is short-lived, until unsettling rumors start to hit the market. Whispers spread that the creators of Rocketcoin vanished overnight, along with all the project's funds. The price of Rocketcoin begins to dip, slowly at first, then big institutional investors, sensing danger, start to dump their holdings en masse. Automated sell-offs kick in, and the market experiences a catastrophic crash. Billy, gripped by panic, sells his Rocketcoin at a huge loss, desperately trying to salvage what's left. But it's too late. He ends up wiping out his entire savings and is still stuck with the loan. But the damage doesn't stop there. It spreads like wildfire. A major hedge fund, heavily invested in Rocketcoin and reliant on borrowed money, suddenly finds itself unable to repay its loans. The lending platform, struggling to stay afloat, freezes all withdrawals, trapping the savings of thousands of unsuspecting people. The cryptocurrency exchange that Billy used to buy Rocketcoin is now under scrutiny and exposed for fraudulent activities. As a result, it halts all operations, putting everyone's funds at severe risk. One bad coin triggers a devastating domino effect, impacting hedge funds, lenders, exchanges, and countless regular people, who all get hit hard. What started as a seemingly harmless rumor ultimately ends in a system-wide meltdown of epic proportions. In the world of crypto, everything is intricately connected, and just one weak link in the chain can unravel the entire system. Billy's cautionary tale serves as a stark warning. In this volatile world, risk travels at lightning speed. A single crash, no matter how small it seems, can bring down the whole interconnected web, and it can all happen in the blink of an eye, leaving devastation in its wake. Behind every crash are real people facing real pain. Investors wake up to see their savings slashed, powerless to stop the bleeding. The shock quickly turns to anxiety, regret, and shame, especially for those who convinced friends to join in. Doom scrolling becomes a daily ritual. Each price check another gut punch. Relationships and mental health suffer as hope fades. The hardest choice, sell and lock in losses, or hold on and risk losing more. Selling feels like failure. Holding feels like denial. There's no easy answer, just stress, sleepless nights, and lasting scars. For many, the dream of financial freedom becomes a nightmare. The human cost of a crash is far greater than any chart can show. So, your portfolio's a disaster, now what? First, breathe. Don't let panic dictate your next move. Step away from the screen and get some perspective. Ask yourself, were you investing for the long term or just chasing hype? Use the crash as a lesson. Learn what's solid and what's just noise. Don't try to time the bottom. Consider dollar cost averaging if you still believe in the tech. Never invest more than you can afford to lose. If you're losing sleep, you're overexposed. Remember, markets are cyclical. Storms pass. Your job isn't to control the market, but to manage your own risk. Build a sturdier boat for next time, and maybe keep less of your savings in a Jenga tower.